They took their best shot. Friday morning, December 13th, 2024, right as the London silver fix was settling, the sell orders came flooding in. The algorithms fired in perfect coordination, the tape painted red across every screen from Singapore to New York. And when the dust cleared at the close, silver was sitting at $67.30 per ounce. Not $63, not $59, not the collapse they engineered. $67.30. This is not a drill. For the first time in 43 years, the banks have lost control of the close. They flooded the market with paper. They raised margin requirements overnight. They activated every circuit breaker in their manipulation playbook. But the price held. While the media is screaming about Bitcoin hitting new highs and the Fed's rate decision, the real story is unfolding in the silver market right now. The most suppressed asset on planet Earth just sent a signal that changes everything. They want you to believe this is just another rally. It's not. This is the beginning of the end of a 50-year control structure. Let's be clear about what happened Friday. At 10:47 a.m. Eastern, silver was trading at $68.15. Within 18 minutes, 47 million ounces of paper silver hit the COMEX order book. Not physical metal, not real bars changing hands in vaults. Paper contracts, digital phantoms designed to create the illusion of selling pressure. This is the lie of omission so massive that mainstream financial media won't touch it with a 10-foot pole. They reported silver pulls back on profit-taking, as if organic sellers just happened to coordinate 47 million ounces in 18 minutes right before the weekend close. Here's the kicker: the London Vault inventory data released Thursday showed available silver dropped to 912 million ounces, the lowest level since August 2021. Industrial demand from Samsung, solar panel manufacturers, and AI server producers is already running at 115 million ounces above last year's pace. Meanwhile, mine supply from Mexico and Peru is down 8% year over year due to permitting delays and resource nationalism. So physical silver is disappearing, industrial demand is exploding, and somehow the price gets smashed by 1.2% in under 20 minutes. Do you see the problem yet? This wasn't selling. This was desperation. This was the banks burning their last ammunition to prevent a weekend close above $68. Why this matters now? Why does $67.30 matter? Because that number represents the failure of the suppression mechanism that has governed precious metals pricing since Paul Volcker's Treasury Federal Reserve Accord in 1980. The close price on Friday, December 13th, wasn't just a number on a screen. It was the settlement price for $4.7 billion worth of options contracts expiring December 27th at $67.30. Over 63,000 call options between $65 and $70 are now in the money. That represents 315 million ounces of silver exposure that market makers are suddenly on the hook for, not in February, not next quarter, right now, today. Already we're seeing signs of panic. JP Morgan's commodity desk sent out a memo Monday morning advising institutional clients to reduce silver exposure ahead of year-end volatility. Deutsche Bank quietly raised margin requirements on silver futures by 22% effective immediately. And here's what they're not telling you. 3 COMEX-approved warehouses requested emergency withdrawals of physical metal Friday afternoon to meet delivery obligations. When was the last time you heard about emergency vault withdrawals? 2011. Right before silver hit $49 and they orchestrated the margin hike massacre. But this time, the setup is different. This time, the physical shortage is real. This time, they can't just print more metal. In this investigation, we are going to expose the 3 converging forces that have created the perfect trap for the banks. We're going to look at the industrial demand surge that's draining vaults faster than mine supply can replace it. We're going to explain exactly how the December options expiration creates a gamma squeeze scenario that forces market makers into a buying panic. We're going to show you the historical parallels between right now and 1980, 2011, and the Chinese rare earth embargo of 2010, and why this situation is actually worse for the shorts. Then we're going to walk through the specific strategies you need to navigate the next 6 weeks, including what to buy, what to avoid, and how to position yourself for the inevitable volatility they will weaponize against you. This is the story of how a 50-year price suppression scheme is collapsing in real time. This is the story of how $67.30 became the signal that the emperor has no clothes. And this is the story of how you, if you held through the manipulation, are positioned on the right side of history. To understand why $67.30 is the line in the sand, you have to understand how silver pricing actually works. Not the fantasy version they teach in economics textbooks, but the reality of paper markets versus physical metal. Silver trades in 2 parallel universes. Universe 1 is physical silver. Bars, coins, industrial inventory sitting in vaults, mines producing roughly 830 million ounces per year, and actual buyers like Samsung who need the metal to manufacture phones and solar panels. Universe 2 is paper silver. Futures contracts on the COMEX, options chains, ETFs that may or may not have full backing, and over-the-counter derivatives that banks trade with each other in the shadows. Here's the critical part they don't want you to know. Universe 2 is approximately 100 times larger than Universe 1. For every physical ounce of silver that actually exists and can be delivered, there are 100 paper claims on that same ounce. This works fine as long as nobody asks for delivery. It's the same logic as fractional reserve banking. Your bank doesn't have all depositors' cash in the vault, but it's fine because not everyone withdraws at once. But what happens when the industrial buyers who actually need physical metal start competing with investors who want delivery? What happens when the float, the metal available for immediate sale, drops below the amount of maturing contracts? Let's do the math, because this is where it gets catastrophic. The COMEX December silver contract that expires December 27th has open interest of 127,000 contracts as of Friday's close. Each contract represents 5,000 ounces. That's 635 million ounces of contractual obligations. Now, historically, only about 2% to 4% of futures contracts actually demand physical delivery. Most roll forward or settle in cash. So you'd expect delivery notices for roughly 12 to 25 million ounces. The COMEX registered inventory, the silver actually available for delivery, currently sits at 48 million ounces as of December 12th data. Sounds safe, right? Here's the problem. Industrial users are now taking delivery at unprecedented rates. In November alone, delivery notices totaled 31 million ounces, with Samsung-affiliated accounts taking 9 million, Tesla-linked entities taking 4 million, and unnamed industrial accounts taking another 11 million. They're not speculating. They're securing supply chains. If December delivery requests come in at just 8% instead of the historical 2% to 4%, that's 50.8 million ounces demanded against 48 million available. The vault is empty. Where does the metal come from? Option number 1. The COMEX declares force majeure and settles in cash, destroying its credibility forever. Option number 2. JP Morgan and other authorized participants raid the SLVETF inventory to cover deliveries, which triggers a disclosure requirement and potential investor lawsuits. Option number 3. They break the price with massive paper selling to scare delivery requests away. They tried option 3 on Friday. It failed. The price closed at $67.30 instead of collapsing below $65. Do you see the problem yet? They can print infinite paper contracts, but they cannot print physical silver. And right now, the industrial buyers who power the modern economy are calling their bluff. This isn't 2011 when retail investors got scared by margin hikes. This is Samsung looking at first quarter 2025 production schedules and saying, "We need the metal, not the paper." This is exactly what happened with palladium in 2000 and 2001. Russia controlled 60% of global palladium supply, And when Ford and General Motors ramped up catalytic converter production to meet new emission standards, they got caught short. Palladium went from $300 per ounce to $1,100 in 11 months. The shorts, mostly European banks who had been naked selling futures, got absolutely destroyed. Credit Suisse alone lost $680 million. But here's the key difference. Back then, there was no social media, no retail army watching every vault movement, no real-time data on industrial offtake. The banks could operate in the shadows and slowly unwind their positions behind closed doors. Today, every vault transaction gets reported within hours. Every major silver purchase by industrial giants gets flagged in import/export data. Every unusual options activity gets dissected by thousands of analysts online. The information asymmetry that allowed the manipulation to persist for decades is evaporating. We're also seeing echoes of the Chinese rare earth embargo of 2010. When China restricted dysprosium and neodymium exports, prices spiked 600% in 6 months because there was no substitute and no alternative supply. Silver in semiconductors, solar panels, and EV charging infrastructure has no viable substitute at scale. You can't just swap in copper or aluminum. The chemistry doesn't work. History is repeating itself, but this time the awareness is global and the countdown clock is visible to everyone. This creates a reflexive doom loop that has no exit. Higher prices make delivery more attractive, which drains physical inventory, which forces market makers to hedge their options exposure by buying futures, which pushes prices higher, which makes more options profitable, which increases delivery requests. It's a gamma squeeze compounded by a physical shortage compounded by industrial demand that cannot be delayed. The banks are trapped in a burning building with one exit, and that exit is getting narrower by the hour. Friday's failed smash attempt proved they've lost control of the narrative. Retail held. Industrial buyers ignored the dip, and the close price at $67.30 locked in catastrophic exposure for the options writers. They needed a close below $65 to kill the gamma ramp. They failed. The crisis point arrives December 27th when contracts expire and delivery notices are due. But the real panic will start December 20th as market makers frantically try to hedge into year-end. We are 72 hours away from the chaos. In Part 3, we're going to look at exactly who is on each side of this trade and why their incentives guarantee an explosion. If you're JP Morgan, Bank of America, or HSBC, the institutions that have dominated silver derivatives for 2 decades, you have exactly 2 choices right now, and both are catastrophic. Option A. Cover your short positions by buying physical silver or long futures contracts, which drives the price higher and crystallizes billions in losses while triggering margin calls on remaining positions. Option B. Double down with more paper selling, burn through what's left of your credibility, and pray that industrial buyers pause their delivery requests long enough for you to survive year-end. They chose option B on Friday. It bought them 48 hours. Their motivations are existential. These aren't proprietary trading desks gambling with house money. These are market-making operations that provide liquidity to corporate clients, hedge funds, and ETF sponsors. If they get caught in a delivery default, the lawsuits will be biblical. Pension funds, sovereign wealth funds, and industrial giants will sue for breach of contract and failure to deliver. The regulatory scrutiny from the CFTC and international watchdogs will shut down their entire commodities divisions. We're talking about a Lehman Brothers-level reputational collapse. So they're fighting with everything they have. The Friday smash, 47 million ounces of paper in 18 minutes, was textbook desperation. They're burning the furniture to stay warm. But here's what they didn't count on. The retail army has seen this movie before and refused to panic sell. While the banks were painting the tape red Friday morning, Samsung's procurement division was placing delivery orders for another 3 million ounces through London brokers. Tesla's supply chain team was locking in February contracts at $67.50. Chinese solar manufacturers were securing December shipments from Perth Mint at premiums of $2.80 over spot. These players have zero interest in the paper price. They need physical metal to keep factories running. Let's be clear. When Samsung designs the Galaxy S25 with improved 5G antenna arrays, each phone requires 0.32 grams of silver. With projected production of 290 million units in 2025, that's 2,900 kilograms of silver just for one product line from one company. Scale that across Apple, Xiaomi, Oppo, and every other smartphone manufacturer. Add in the solar panel boom driven by government mandates in Europe and North America. Add in the AI server farms being built by Microsoft, Google, and Amazon, each requiring silver-based thermal interface materials. Add in the EV charging infrastructure rollout that demands silver conductors for high current connections. The industrial demand side is non-negotiable. These companies cannot delay production because silver got expensive. They have customer orders, shareholder expectations, and government contracts. If anything, high prices accelerate their buying because they fear getting priced out entirely. This creates inelastic demand, which is the short seller's nightmare. No matter how much paper the banks dump, industrial buyers keep vacuuming up physical metal. This isn't just a short squeeze. This isn't just industrial demand. This isn't just a gamma ramp. This is all three happening simultaneously in a compound feedback loop that amplifies each component. Think of it as a financial pincer movement where the enemy is surrounded on three sides with no retreat. Side 1, the short banks who need to suppress price to avoid delivery obligations. Side 2, industrial buyers who need physical metal regardless of price. Side 3, retail and institutional options traders who are now deep in the money and demanding delivery to capitalize on the spread. Each force intensifies the others. When industrial buyers drain physical inventory, it exposes the naked short positions. When the shorts try to cover by buying futures, it triggers the gamma squeeze from options expiring in the money. When options holders demand delivery, it forces more physical drain, which terrifies industrial buyers into securing even more forward contracts. It's a trap within a trap within a trap, and the timeline is collapsing. We are not talking about a multi-year squeeze like the 2000s gold bull market. We are talking about a 6-week window from December 13th to January 31st where contracts expire, delivery obligations mature, and year-end accounting forces everyone to mark positions to market. The banks cannot hide, the industrial buyers cannot wait, and the options holders have already won the lottery. They just need to collect their tickets. For the first time in 43 years, the shorts have no way out. We are already seeing signs of this perfect storm materializing in real time. On December 11th, Mexico's economy ministry announced new permitting delays for 3 major silver mines in Chihuahua, cutting projected 2025 output by 14 million ounces. On December 12th, the Silver Institute released preliminary data showing industrial demand through November running 18% above 2023 levels, with solar applications up 34% and electronics up 11%. December 13th, Friday, Deutsche Bank raised silver futures margin requirements by 22%, effective immediately. This is the same playbook they used in 2011 right before the crash, but this time, the market shrugged, the price held. Also on Friday, 3 separate reports emerged of COMEX warehouse inventory being reallocated from eligible to registered status, indicating that previously untouchable stockpiles are now being prepped for potential delivery. That's the equivalent of a bank moving money from savings accounts to checking. It signals panic. Over the weekend, silver premiums in India spiked to $3.15 over spot, the highest since Diwali season in October. That indicates physical shortages are spreading beyond Western markets. In Germany, online dealers reported selling out of 100-ounce bars for the first time since March 2023. These are not isolated incidents. These are symptoms of a system breaking down in slow motion. The data validates the theory. The squeeze is not coming. The squeeze is here. The question is no longer if, but How violent will the snap be? Here's what you need to understand. If you are holding physical silver right now, you are positioned on the right side of the most asymmetric trade of the decade. The window is closing, not in 6 months, not next quarter. In the next 3 weeks, the market will decide who gets paid and who gets liquidated. The banks have already shown their hand. They tried to break the market Friday and failed. They have no more ammunition. Every paper dump from here just creates a better buying opportunity for industrial giants who need the metal. But you need to be smart about this. The next 3 weeks will be brutal, not for the price trajectory, but for your emotions. They will try to shake you out. On December 20th, when market makers start panic hedging, you will see violent intraday swings, $4 moves in 20-minute windows. On December 23rd, they will orchestrate a year-end tax loss selling narrative to create one final flush. On December 27th, when delivery notices are published, the media will spin it as lower than expected, even if the numbers are catastrophic for the shorts. Do not let short-term volatility distract you from the macro reality. Physical silver is disappearing, industrial demand is non-negotiable, and the paper market is a house of cards. You are early. You understood the game. Now you have to have the discipline to let it play out. Strategy number 1. If you do not yet own physical silver, buy 100-ounce bars from reputable dealers this week. Avoid collectibles, avoid numismatics, avoid anything with high premiums over spot. You want maximum ounces for your currency. The premiums are already rising, $2.50 over spot as of Monday morning, and will likely hit $4 to $5 by December 20th as retail panic buying kicks in. Get your metal now before the spread blows out. Strategy number 2. If you are already holding physical, do absolutely nothing. Do not sell into the volatility. Do not try to trade around the position. The whole point of owning physical is insurance against exactly this scenario: systemic breakdown and paper market failure. Your metal is your ticket to the other side of the squeeze. The temptation will be enormous when you see a $6 spike in one day to take profits. Resist. This move is not measured in days. It's measured in months. Strategy number 3. If you are trading paper silver, futures, options, or ETFs, understand that you are playing a different game. You can capture explosive percentage gains, but you are also exposed to margin calls, forced liquidations, and potential cash settlement if the COMEX invokes force majeure. Set hard stop losses below key technical levels. Do not use more than 20% of your trading capital on any single position. Take profits in increments as the price rises, but leave a core position to capture the full move if the squeeze goes parabolic. Strategy number 4. Avoid silver mining stocks for the next 3 weeks. This sounds counterintuitive, but mining equities lag physical metal during violent short squeezes because institutional algorithms dump everything in the commodities bucket during volatility. Miners will have their day in January and February when the dust settles and investors start pricing in higher silver revenues. For now, own the metal, not the proxies. Let's be clear, next week will test your conviction like nothing you've experienced in this market. Not because the thesis is wrong, not because the fundamentals changed, but because they will engineer maximum psychological pain to force weak hands out before the real move begins. On December 18th or 19th, they will drop the price $3 in the first hour of trading, and the headlines will scream, "Silver collapse." Your group chats will fill with panic. Financial Twitter will declare the squeeze dead. This is the shakeout. This is exactly what happened in January 2021 with GameStop, in February 2020 with Tesla, and in April 2011 with silver itself. They will try to make you believe you were wrong, that you missed the top, that you should cut losses now before it gets worse. Do not fall for it. The industrial buyers are not selling. Samsung is not canceling production. The physical shortage has not resolved. The delivery obligations have not disappeared. Volatility is not the same as a broken thesis. If you held through Friday's smash, you have already survived their best shot. Everything from here is noise until December 27th. We are living through a historic pivot point in monetary metals. The 50-year suppression regime that began when Nixon closed the gold window in 1971 and accelerated under Volcker in 1980 is collapsing in real time. Silver at $67.30 is not the top. It's the signal that the control structure is breaking. They want you to believe this is just another speculative bubble. They want you to believe industrial demand will slow down. They want you to believe they can just print more metal or find substitutes. But the physics say otherwise. The chemistry says otherwise. The vault data says otherwise. Congratulations to the diamond hands who held through the Friday smash. You understood that paper is not metal. You understood that suppression creates coiled energy. You understood that when the industrial buyers join the retail army, the game is over for the shorts. You got this right. Not because you got lucky, because you did the research. Because you ignored the manipulation narratives, because you recognized that $67.30 is not a ceiling. It's a floor that just got locked in by the options expiration structure. The next 6 weeks will be remembered as the moment the silver market broke free. You are on the right side of history. Now hold your position, trust your analysis, and watch the banks scramble for exits that no longer exist. This is not a drill. This changes everything. The signal has been sent.